positive session there today after Wall Street strode to those new record highs overnight. Looks like nothing is getting in the way of the market right now.
Good afternoon, Leanne. Yes, look, I'd have to agree with you. It's the third session in a row that we've seen pretty strong gains for the Aussie market. It is very nice to see. The gains are broad-based, as we saw in the US overnight. I think that's particularly important. And it appears as though Santa has come early. The fabled Santa Claus rally may, in fact, already have arrived.
It's interesting because we were just talking to you last week, Chris, and you were calling for a rally post the FOMC meeting next week and then a rally in the back half of the month. Traditionally, that is what we see with this so-called Santa Claus rally, but it really looks like it has come early, as you say. I think the question now, though, is whether these gains are in fact sustainable.
Yeah, look, absolutely. There's no doubt that I had thought that it would be post the Fed decision that, you know, that would, as I said last week, would really bookend what has been a very busy and very turbulent year for markets in terms of macro events. But yeah, like you say, it appears as though the rally has come early. I think importantly, if we close sort of where the market is now, this afternoon, if we close at the same levels, the market will have punched through 5,500, so it will leave only the 56.11 high from earlier in the year and the 12-month high for the market to clear in order to create some further clear air for the market to rally into. I don't know whether you've got the chart up on the screen there that I provided in what I sent through earlier, but there's been an uptrend support line that was breached in late October, early November once this year. It's been in place sort of since the February point of this year, and it appears again and right now that it's supporting prices. So there really doesn't seem to be a lot in the way, apart from that 56.11 high that I mentioned earlier, that's holding the market back. And there's nothing sort of fundamentally or from a macro perspective either. You know, the Italian referendum is out of the way. And just like other events that we've seen this year with regard to Brexit and the US presidential election, markets rallied, you know, they sort of dipped initially on the Italian referendum, or at least the Australian market did. And then that preceded this three-session rally that we're still experiencing at the moment. So it's that same pattern of there being weakness on the day of and in and around a big macro event. And then the market just says, well, we've got the outcome now, whether it be good or bad or indifferent, or whether it was what we thought was going to happen or didn't. Let's just get on with the business of being a market and rallying. So that is all out of the way now. I think the rally starts, or has already started, and hopefully, very hopefully, we can have a really, really strong December and a really nice rally into the end of the year.
With all of these factors out the way, we've been seeing a number of analysts weighing into their year-end targets and coming into 2017. Credit Suisse now calling for that 6,000 mark. Macquarie calling 58.70. Of course, today really rallying to that 5,500 mark. What's your end-of-year target, Chris?
Look, I honestly hadn't lent much thought to it until you posed the question to me just then, Leanne. I think certainly we can clear the 56.11 level. I don't think, you know, we're not too far away from it now. Maybe another 2% from where we are now, so sort of ballpark 5,700 I think would be a nice way to end the year. Considering, again, over the last three sessions, what are we now up over the last three sessions? Probably cumulatively 140 points maybe. So if we got another 200 on the back of that, I think that would be a pretty good result.
Now, if Santa Claus does live up to its reputation, we do see the market continuing, as you suggest, a number of analysts are suggesting. What would you be buying at the moment?
Well, if it lives up to its reputation, and that's the key, there almost isn't anything you wouldn't buy. What I found really interesting in the States overnight, and indeed what we've seen locally in the past three sessions, is that the rallies have been very, very broad-based. Of course, healthcare in the US didn't do so well overnight because Trump stuck his finger in and sent out a tweet or whatever it was that he did that hurt some biotech shares. But aside from that, the rally was broad-based, and that really says to me that this rally has legs, and that there are many, many people out there who are willing to bid the market up. So you could, on that information, buy almost anything. But getting, you know, a little bit more specific and a little bit more pointed, that I would stick with the banks and the miners. You know, if this is going to be a broad-based rally, there's no need to reinvent the wheel. You buy things that are already strong, rather than, you know, say the opposing view of buying healthcare, which has been beaten up 20%. Or buying some of those bond proxies, you know, which have also been smashed to the tune of 20 or 30%. I think you steer clear of them. You buy what's been working in anticipation of what's been happening continue to happen into the end of the year. So, yeah, I don't think there's any need to get cute with this. I think it's the banks and the miners. You continue to ride that wave until the market tells you that you should no longer.
Would you have a preference for any of the banks and the miners for that matter? I mean, would you looking at BHP, say, for a diversified investment in your portfolio? Which ones would you target?
So on the mining side, absolutely BHP. And again, I think we had this conversation last week, Leanne, because it is diversified, exactly as you say. So it's got exposure, of course, to oil, iron ore, and a number of other commodities as well. Fortescue, I don't think you can go past. You know, that's an amazing story, what it's done in the last 12 months. You know, sort of doubling in share price. I think that is one that you could happily buy right now and expect to be higher by the end of the year. South 32, another one. Again, they've got a lot of quality assets. Probably isn't still quite yet fully priced. You know, there's analysts across the board, probably even as we speak, revising their targets up for commodities and sort of playing the chasing game as well. They're still behind what the market is actually doing. So potentially all of these stocks have further to run. In the banking sector, probably CBA, now that it's sort of punched above the range that had been holding it back. I think it was capped at about $79 or $80. It seems to be through that, so into some clear air. And the other one that I personally have liked for a while in the banking space is ANZ. So ANZ and CBA would be the two for me in the banks.
Okay, fantastic. Let's talk some of those energy stocks, and in particular, Santos. We're watching today with this news out around simplifying their portfolio. The stock's up about 0.5% at the moment, $4.38. Now, we did hear from Santos CEO Kevin Gallagher a little earlier around the company's plans. Let's take a quick listen.
We'll simplify our portfolio to focus on these 5 core long-life LNG and domestic gas assets. Each of these assets offers stable production, long-term revenue streams, and significant upside opportunities. Our aim for this portfolio is to generate free cash flow positive business at a $35 to $40 level on a sustainable basis.
Now, Chris, just a thought from you. Obviously, a pretty important part of the announcement today is that they are going to be divesting most of those non-core assets. They obviously made some other really interesting points around free cash flow and debt reduction. What were some of the key highlights for you?
So, I mean, for me, a lot of what we heard today was sort of as expected. It was about asset rationalisation, cost out, you know, reducing capex, freeing up cash flow, paying down debt, things that the likes of Fortescue have done. Obviously, Origin was out earlier in the week saying that they were going to divest some non-core assets as well. So they're all singing from the same hymn book, so to speak. And as I said, in that regard, it was as expected. I think one of the highlights for me was their reduction in cost from $47 a barrel down into $39. I think that's excellent and should be rewarded. So there were quite a few positives to come out of it. I think why we've seen a bit of a pullback in the share price, because from memory it was up about 3% off the open this morning, and as you just stated, it's now only up about 0.5%. I think some of the estimates for 2017 look a little bit disappointing once you factor in a few things like asset sales and a ramp up in GNLG. It suggests that they're slightly lower on an equivalent basis. So I think that might be one of the reasons why we've seen a pullback in the share price. But overall, like I said, a lot of positives and what you would expect from a company that's trying to tidy up its cash flow and pay down its debt, as it well should be doing at this stage of the cycle.
Looking at Santos relative to some of the other energy plays, as you point out, it is a more speculative play, isn't it? They're obviously very leveraged to the oil price move. They still have a large amount of debt. And then, of course, you've got the Aussie dollar, which is a risk given that a lot of their debt is denominated in US dollars. So would you be looking at this as more of a speculative play?
Yeah, I would have thought so, and exactly as you say, it's because of their debt load, you know, which compared to other players in the space is significantly higher and sort of always has been. If you're willing to take on the risk, though, and if you expect oil prices to remain above $40 a barrel, as their CEO does, it could very well be worth having a crack at. I think he said in his presentation that for every $10 in oil price above $40 a barrel, it's worth to them an extra $300 million. And with an average oil price of $55 a barrel, it generates somewhere between $900 and $1 billion of extra cash flow for them. So there's a lot of upside on offer, but it all depends on the oil price. And if you want to tie yourself to that, well, then certainly Santos would be the way to play it. And of course, that means that, like you say, it's more speculative. You're speculating on the underlying commodity.
All right, fantastic. Chris, we might wrap it up there, but it's been great talking to you as always. Really do appreciate it. Thank you.
Thanks, Lan.
Chris Conway joining us there from the Australian Stock Report with all of today's moves. Now,